Venture debt is often described as a simple supplement to equity financing, a way to extend runway without dilution, a bridge between rounds, a financing tool that leaves the cap table largely untouched. That description is technically accurate and strategically misleading. Venture debt is not about replacing equity. It is about reshaping control without visibly changing ownership. Its real function is not dilution avoidance, it is bargaining leverage. Once you view venture debt through that lens, its role in startup governance becomes much clearer. In early-stage companies, equity is the dominant organizing mechanism. Ownership determines control, incentives, and downside exposure. Founders negotiate valuation. Investors negotiate board seats and protective provisions. The cap table is treated as the primary map of power. Venture debt operates off that map. Instead of ownership percentages, it uses covenants, repayment priority, and warrants to create what can best be described as shadow equity. Economic influence without formal control. Leverage without vote. This matters because bargaining power in startups is rarely exercised at the moment capital is raised. It is exercised later, when conditions change. Debt introduces a new actor into that future. At a mechanical level, venture debt appears straightforward. A lender provides capital, typically after a priced equity round. The loan is senior to equity, secured against assets, and accompanied by a small warrant package. The warrant coverage looks modest, 1 or 2%, sometimes less. On paper, dilution appears minimal, but governance is not determined by percentages alone. It is determined by constraints. Covenants are the key instrument. Venture debt covenants impose operational and financial conditions that the company must satisfy. Minimum cash balances, revenue thresholds, restrictions on additional debt, limits on major expenditures, reporting requirements, default triggers tied to future financing outcomes. Individually, these terms appear reasonable. Collectively, they rewire the company's decision space. The presence of debt changes how risk is priced inside the organization. Equity tolerates volatility. Debt does not. Once debt is introduced, downside scenarios carry asymmetric consequences. A missed milestone is no longer just a valuation problem. It becomes a solvency problem. This shifts internal priorities long before any default occurs. The real power of venture debt emerges between rounds. In a clean, equity-only structure, a startup that underperforms can often renegotiate. Valuations reset. Terms adjust. Existing investors decide whether to support or walk away. Founders retain some leverage because equity investors are already exposed. Debt complicates that dynamic. If a company needs a down round while carrying venture debt, the negotiation set shrinks. New investors must account for senior claims ahead of them. Existing investors must consider whether fresh capital will primarily stabilize the lender's position rather than drive growth. The debt holder does not need a board seat to influence this outcome. The capital structure does the work. At this point, warrants matter less than priority. The lender's claim sits above all equity. In a restructuring, repayment comes first. In an acquisition, proceeds flow through the debt before touching the cap table. Even without exercising warrants, the lender shapes incentives by altering who bears downside risk. This is why venture debt can function like shadow equity. It does not vote, but it constrains. It does not dilute directly, but it shifts who must agree for outcomes to occur. Founders experience this most acutely when optionality disappears. With debt outstanding, certain strategic moves become harder. Aggressive pivots, risky acquisitions, extended fundraising timeline, each increases the probability of covenant breach or liquidity stress. As a result, management behavior changes preemptively. This is not lender interference in the traditional sense. It is governance through architecture. Venture debt providers understand this dynamic well. They price loans not only on credit risk, but on sponsor strength and follow-on capital availability. The presence of reputable equity investors is often a prerequisite. In effect, lenders underwrite the equity syndicate as much as the company. That creates a triangular relationship. Equity investors know that debt can discipline founders. Founders know that debt can limit negotiation flexibility. Lenders know that both parties want to avoid default optics. The result is a subtle redistribution of power. Importantly, this redistribution is invisible if one only looks at dilution percentages. A founder may proudly note that a round was extended with debt instead of equity. Ownership remains unchanged, but bargaining leverage has shifted. The company is now operating inside a narrower corridor of acceptable outcomes. That corridor tightens further in downturns. When markets are strong, venture debt feels benign. Refinancing is easy. Growth covers obligations. Covenants remain dormant. In these periods, debt appears almost free. But venture debt is procyclical. Its governance impact intensifies precisely when conditions deteriorate. During demand shocks or funding contractions, debt accelerates decision-making. Companies must raise sooner, accept harsher terms, or pursue exits under pressure. Equity investors face the choice of supporting the company or protecting their position relative to the lender. Again, this is not malice. It is structure. From an institutional perspective, venture debt exists because equity investors value optionality but dislike dilution, and lenders are willing to monetize priority and constraint rather than upside alone. It fills a specific niche in the capital stack, but its implications are often misunderstood because they do not show up in headline metrics. Founders track valuation. Investors track ownership. Debt operates in the background, shaping negotiations without appearing in cap table summaries. This leads to a recurring analytical error. When startups struggle, postmortems focus on product-market fit, burn rates, or leadership decisions. Rarely is capital structure treated as causal. Yet in many cases, the presence of debt materially changes the range of viable responses. A company without debt can wait. A company with debt cannot. This difference is not about competence. It is about constraint. Understanding venture debt requires abandoning the idea that control flows only from equity. In modern startup finance, control is distributed across instruments. Priority, covenants, and timing can matter as much as votes. Venture debt reshapes outcomes not by owning the company, but by narrowing the future. That is its true function. For continued institutional analysis of capital structures, bargaining power, and governance design, subscribe.